Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, July 30th, 2018. It's only a few minutes before the markets close. I was going to wait till the markets had closed to do an end-of-day market wrap. I did put out a video early today for members of the site that included an update on the markets, as well as some other things I'm watching right now, some interesting developments going on in crude oil, natural gas. I covered a few trade ideas. This is just going to be a brief market wrap, only covering the broad markets here. We'll focus on SPY, QQQ, the futures, and maybe touch on the small caps. We'll see. But all right, let's just start out here with the NQ 60-minute chart. This is where I've been leading with lately, what I've been leading with, and trading. And so what's happened recently, just to rehash, is we had this divergent high right here. And we went down, we hugged this trend line. This was the most significant level to watch in recent weeks right here. Trend line was broken. That led to impulsive selling, which helps to validate the trend line. We had a little bear flag type action right here. That's a continuation pattern. And now we fell to my preferred swing target zone. I had these levels right here. About the top of that's about seven. Here, I'll tell you where it's at. Let's put the crosshairs. The bottom of that zone comes in right around 71.63. Now, what that is and what I'm watching, we're going to look at QQQ and SPY here in a second. That's a pretty significant level. There was this bottoming pattern, this basing type pattern in late June, early July. We put in a divergent low, so that was bullish right there. We had positive divergence at this point, started to move up, and finally, boom, we broke out the top. So when I go back in time, I look at all the reactions. Let me try to circle these for you. All right, let's clear that out and show you why I think this is a significant level, and then what we should, what you might want to look for in the next day or two. I'm going to talk about Apple here in a second, obviously. So I see a lot of reactions along this level to help validate it, particularly, most importantly, right here at this point in time. Once we gave up that level here, it was support, support, support. Boom, support was broken, and what happens? We had impulsive selling. That helps to validate that as an important level. The fact that we just didn't limp through. And then once support was broken, in technical analysis, support once broken becomes resistance. And you can see one, two, three failures there. And then boom, we finally popped. Sort of has a complex inverse head and shoulders bottoming pattern look to it. But either way, we took it out. We moved up, we put in a divergent high, and now we've corrected and we came back to it. So that's why I had that level as my preferred near-term swing target. I'm going to talk on this in a second. That's off the 60-minute charts. There's certainly the potential for more, but here's the thing. We have Apple on deck tomorrow after the bell. That will undoubtedly have an influence on the markets, particularly the NASDAQ 100. So there we just had the closing bell ring as I'm doing this video. So when we get to QQQ charts and SPY charts, they're not going to be trading anymore, and we'll kind of wrap up where they ended the day. So that's it. Yeah, so we're at support. We're at a near-term target. I will point out there is potential bullish divergence. You can see here on the PPO and the RSI as the NQs went on to make a lower low. These indicators are making a higher low. So if we reverse, and I'm leaning towards that scenario, at least before until Apple reports. I think one of two things will happen. Either the market will kind of slog around for a day or two, or well, for another day now. Today's over. Tomorrow, and I don't think it'll do much in front of Apple. And if anything, we could have a little bit of a relief rally here because that target's been hit. But I don't think it would go much beyond this level here. This was a former support area right here. All these lines were support levels. They've been taken out. Now they're resistance. So I think due to the fact Apple's reporting, and based on everything that's happened this earnings quarter, we had the big miss and drop by Facebook, Netflix, Intel. I think the Apple shareholders are going to be a little worried, especially those overweight, both individual investors, institutions, anybody overweight Apple. Heck, I would be. Apple's a great company, but right now the market it has a zero tolerance for any misses or even beats for that matter. You got to blow it out of the water. I mean, I don't think Amazon's earnings could have possibly been any better, but they've already faded all those gains, which, by the way, I pointed this out on the site today in the earlier video, or no, in the trading room, I'm sorry. All of the FANG stocks, Facebook, Amazon, Apple, Microsoft, Alphabet, even Intel, the sixth largest holding, and Netflix as well, one of the FANG stocks, FANG, are all below where they were before the day before they reported earnings, or where they closed right before they reported. So I think that's something significant to note. It says a lot. A few days doesn't make a trend, but every single market leading stock, the largest six top components of the Nasdaq 100, many of those are also top components of the um, S&P 500. Of course, Apple hasn't reported yet. That's the one exception. All the rest either dropped immediately follow earnings, had a pop after earnings like Amazon, Microsoft, and then saw those pops, all of them have been faded and then some by today. So that's interesting to note. It speaks a little to what's going on in the market. Tells you maybe things are getting a little toppy, but again, the big theme is I think that we had a couple of the big market leading quote unquote invincible bulletproof stocks show you that they're no longer bulletproof. And if anybody, Facebook, of course, Netflix took it down pretty hard. Intel was already in correction mode well before the earnings came out. So, and I think again that set the tone. So what I'm getting at is tomorrow, let's wait and see. I wouldn't do, if I didn't have a position in this market right now, I wouldn't be doing a lot. I think the best time to short the Qs was anywhere up here. Right now, not objective because of what I just mentioned. We're at support, hit my target hit, some potential divergence. So, tomorrow maybe a little upside, but the best thing to do is wait and see what happens with Apple and the market afterwards. Here's ES. I'll get to SPY and QQQ in a second, but ES are the S&P 500 E-minis, and yeah, the same story. With a divergent high, simple watch, rinse, repeat stuff, as I like to say. Look for these divergent highs, negative divergence, especially if you can align it with a trend line break. Divergences are not sell signals, it's trend line breaks or any other type of sell signal, especially if you get some impulsive selling like you had there. That's what usually sparks, validates a breakdown. Then you get the correction, then you look for a divergent low, go long. And you look for these divergent highs, and particularly with a trend line break. So that's what we had in SPY. You had a trend line break, impulsive selling, took out the both trend lines, this larger, more significant trend line. And where we're at today is we hit support. And this is a very well defined support. In fact, probably as significant as that support I just showed you on NQ. Now, talk about this real quick. So here was your previous high. We had a few attempts there. We failed. Came back up at it again, tried and failed. Finally, we broke out. Boom. This is a breakout to not all-time highs or new highs, because remember the S&P 500 peaked back in that blow-off type rally in January. But it is a new multi-month high, so we took it out. This is TA 101, back tested successfully, back tested again, had a little rally, back tested it again, boom, and then moved on. So to me, this is a very significant level. We've already back tested that level several times. We're back testing it once again, which isn't the best thing. Usually, it's a back test is normal, but you've had a lot of tests here. It should have been an opportunity for the S&P 500 run. It looks like this market's getting very heavy, in my opinion. And again, the longer-term charts will tell us a little bit more. So, point being, this is a level to watch, because if we break it, there's some minor support levels along the way, but my target would be, if we have an impulsive break and close below this level, is that same. Remember on the NQ, I was showing you that late June, early July basing pattern there, where the market bottomed, base, put in a divergent low. SPY up to that point, or ES, I'm sorry, in this case, the S&P 500 E-minutes looked almost identical. You had, support. We had some reactions there. So we fell, break. This was a breakout right here. So in other words, so this is a big thin zone, and that would be a downside target for the SPY, a natural target if it breaks. And again, if we look at NQ, this is ES. I'm going to flip back to NQ. Sorry for all the confusion. There it is. So you can see what happens. And this is just a nice visual of the underperformance due to those large tech stocks, those market leaders. We're already back to that same. These charts look very similar up to this point, where you have the SPY way up here, back testing its previous breakout there, or ES, I should say. I'm using those almost interchangeably, but the charts look a little different. In fact, let's look at those for you, because I know most traders use SPY or NQ. SPY or QQQ. Man, I'm all over the place today. Trying to get this video out. Sorry guys, it's been a long weekend. All right, so here's a QQQ 60-minute chart. Let's forget about what already happened. We already know I've covered that a lot. Divergent high right here, breakdown. So today we hit, this was my first target zone. I've had these targets out here for a couple weeks. 175.86 to 10 to 175-ish right there. Went a little bit below there and fell a little shy of my preferred swing target T2 right now. But again, that is why I watch both those charts. My go-to personal preference is to trade NQ because it trades around the clock and I can put in stops and that way I'm not subject to big opening gaps. If there's a huge move down or up in the futures and I'm long or short, I can, have my stops hit. Whereas if you're long or short QQQs, yeah, there's a little bit of after hours trading, but you can't put stop loss orders to be filled after hours. You have to sell and buy stocks with limit orders in the after hours trading. So QQQ and SPY, those kind of things. And then of course it shuts down after the after hours session and you have to wait till the next morning. And then of course there's usually not a lot of liquidity right when the after hour or pre-market session opens. Kind of ramps up as people start waking up here on the East Coast. Anyways, so that's that. That's what we had. Fell a little bit shy there, but again, I showed you that we fell all the way down on the NQs, so to the top of this same range. It's that same basing pattern, bottoming pattern right there, divergent low on QQQ. So anything could happen. Maybe we'll hit it. Usually these well-watched targets are filled. So maybe a pop down tomorrow. It wouldn't surprise me to see a little gap down in the morning and then a reversal. But again, with Apple on deck, I don't expect a lot of fireworks. My max upside target before Apple reports would be back up here at about 177.70, somewhere around there, which again is that level where that was our previous high. We had a reaction. We finally broke out, back tested it again, flagged right on it, and then broke down today. So there it is. And again, there's potential to go either way depending on what Apple does. Let's look at SPY real quick and then we'll zoom out to the daily charts and wrap it up. This is a SPY 60-minute. There's our little bearish pennant right there. Breakdown of this bearish rising wedge, impulsive selling, consolidation breakdown, and SPY, just like I showed you in ES, is back testing an important level. We had the highs back in June. Remember, not the all-time highs, but the highs since that top back in late January. We tested it, failed, tested it again. Finally, we broke out right here and back tested for a while. Successful back test, rallied up, but it was a sucker's rally. There was a divergent high. Writing was on the wall. We'd probably get a correction, and we have. So now, here's the thing. The onus is on the bulls to take this and run. This is another back test. And the bears, they want to see that level get taken out with conviction, and then what that'll give us is a false breakout or a failed breakout. And I'm referring to this whole period of trading right here. That's the breakout level, and to come considerably back down below that means that will be what we call a bull trap or failed breakout. So again, it's simple. If you're bullish and believe the market's going much higher in 2018, I can't promise you anything, but I can say this is a very objective level to go short with a stop somewhat below. Again, the market's tricky. I can take it up. I'd almost put good odds. I'll probably run it below there. Doubtful you're going to get such a perfect back test again. Usually they'll run it down below if this bullish scenario is going to play out. That's if it's going to play out, and that'll help clear some stops, suck in some more shorts, and then gun it up. Whereas the bearish scenarios, maybe that breakdown is the real deal, and we go a lot lower. If we do, I think I said this on ES, a natural target would be the same top of that basing range right there. And there's, again, a lot of reactions. It's a pretty significant support level, and it remains my final near-term target zone for SPY if that level's hit. So let's see what happens. Let's look at the daily charts and we'll wrap it up. Okay, here's the daily charts. Tell you a little bit more about the big picture. Here's a trend line. S&P is still well above this trend line, but it is below this more significant longer-term trend line. That trend line, that orange one, goes back to early 2016. A lot of reactions on it. SPY is broken down and back tested. Based on that alone, this puts me bearish on SPY. I think we're going to see more downside. This was a breakdown. We've been back testing it for months, but that's not unusual. There's an alternative, almost parallel trend line to the other one. So watch this. Again, you can see this will be the bigger picture for the bears. This is what they want to see. They see a breakout here to new highs. It was also, indicative of a blow off top followed by a very sharp correction. And we've had several attempts at it since, and we finally broke out, but a lackluster breakout, not a lot of follow through, and we're already back testing. And see on the daily chart, you don't see as many back tests here. This pretty much is the first back test. Don't count that as a breakout. It didn't go very high. Count that big green candle as a breakout. So now we're back testing, and that's that. Let's see where we go. PPO is a momentum indicator, one of my favorites, similar to the MACD. It is clearly rolling over now. It's about to cross, hasn't done so yet, but you can see it curling down. I'm referring to the orange line on top. If you get a bearish crossover, it's not the be all end all, but it just is another check mark to the bearish case. Sometimes you can get a crossover and then things flips back around. When I draw it this way, I see negative divergence now on the SPY, just like we had on almost divergence there, about almost a flat line, but definitely negative divergence on the PPO, on SPY, just like we had on the the leader, if you will, QQQ. I'm trying to move that arrow there. So we had a divergent high here, big correction. We had a divergent high right here. Its most recent high was a divergent high. Really, all these are just an extension, one larger divergent high. That'll show well on the weekly chart too when we look at QQQ from this point to this point. So you have the PPO, the RSI making a series of lower highs with prices pushing up, making higher highs. You have an impulsive breakdown of that trend line. The Qs are coming back in. This is a pretty significant level, about 174 on the Qs, and they're back testing right now. So again, a lot will have to do with what Apple does. There was that previous high. We took it out there, lackluster breakout, back tested, then fell back below, took it out again. This just looks like a market running out of energy to me. I know the fundamentals are great right now. Earnings are overall really good, excluding Facebook and a couple others. But there are times where just everybody's bullish and long, and valuations get high, and so you can have good stocks with good earnings actually go down. And we're not there yet. There's work to be done. Some trend indicators, especially the longer term trend indicators, even the intermediate term trend indicators are still bullish. So I'm giving you levels here that bears want to see broken, and they can trigger additional sell signals, or bulls can use those levels to position on a pullback and go long. And if you are bullish, again, thinking this market's going to new highs, you got to buy when no one else wants to, and that's lately. I'm sure all the bears are coming out of the woodwork right now with what's gone on over the last few days, changing their tune if they were bullish back here. It's just how it works. You have to buy when everyone else wants to. And I'm not advising. I'm leaning towards the bearish scenario here based on these longer term charts. You look at the weekly chart. There it is, QQQ, big negative divergences. PPO is rolling over even on the weekly right here, poised to make a bearish cross. And as I've warned before, and these aren't scare tactics, they're just be ready if it does break down. If Apple does somehow, have a big negative reaction to earnings, that will likely trigger some more selling, which will cascade over, and it can happen fast. We can move very quickly to this primary uptrend line, and then you have that 40-week, 200-day moving average just below it, these weekly divergences. And I always say this: stocks tend to fall much faster than they rise. And if you don't believe that, if you're new to trading or investing, just go back and look at the periods of corrections and then measure the number of days, count the candles, go to a weekly chart, count the number of weeks, and you'll see, like in this case, in just, what is that, 4, 5, 6 weeks, whatever, months, or actually a year or more of candles were wiped out. That's common to see that happen. There is another period where you took several months to move back up, and only probably about a month or so to wipe out all those previous candles there. So can happen here, may or may not. Let's just see what happens going forward. And again, let's see what happens after Apple reports tomorrow night. And here's SPY on the weekly time frame. That's off the um, The bull market lows when the bull market began back in March of 2000. That's the trend line I'm watching right now. We've been dancing on it for all of 2018, actually. We hit it in that first correction in January, early February, and we've hit it several times since. And again, we had this, what I call an alternative trend line here. It's also very valid, a lot of reactions. We're testing that from below. So we're wedged between an alternative and then the primary, more important trend line. And it would actually be perfect to see SPY pop up, take out that high from January. Because if so, you can see here the indicators are severely lagging. If it happened anytime soon in the next month or two, it would certainly be a divergent high. These indicators could not move up enough. So you'd have negative divergence, but you may not get that. We don't always get what we want. Um, it's just one possibility, but it also speaks to the fact I think the risk reward right now is not favorable. So the market does go up. My most bullish scenario in SPY would be, maybe a few percentage points, 5, 6, but I feel confident that the next 10 plus percent from this point is to the downside before the upside. So, nice little correction back to this level might set up for a nice bounce. And that level I'm talking about is the previous lows from earlier in this year when we had those two big corrections. So you can see those lows there on SPY, QQQ. But they're important levels. If they get tested, there's going to be a lot of fear in the market because if they go, and the problem is, if we test them on QQQ, the only way we're getting there from here is taking out this primary trend line. So at best, if we go down there and they hold, I would see at best a kickback to back test the trend line from below and then another move down. So again, let's see what happens. I'll wrap it up here with IWM because I said I'd get to the small caps. Same story, IWM, negative divergence, but we're above trend. The trend is bullish. It's only, relatively mildly off the highs, but you have again these negative divergences, the PPO curling over, making a bearish crossover, and that's the level to watch on the weekly chart is that trend line off the early 2016 lows. And then IWM daily chart, same thing. Watch, rinse, repeat. Look for these divergent highs and divergent lows. You can get divergent high, correction, divergent high, correction, correction, correction. Most recent divergent high, it's actually a double top high. So they're both, that was a divergent high, but so was this one. So really, we can count it from here. And if IWM cracks, this is the trend line to watch. Just a little more downside. You have a trend line. You have the pretty important 160.19-ish level. Why is that important? Well, we had a double top right there. We finally broke out and back tested there. So that's where we'd come in and back test. So these two levels, this trend line and that 160-ish area come in together. So again, here's a level, a very significant support level. Bulls, you might want to step in there and buy with a stop below. Shorts or bears, you might want to wait for a break of that level to position short for a potential swing short that could take us. I could see it taking us easily all the way down here, and that'd be a nice drop in small caps. That would be a drop of about, let's see, 8, 19, 20%. Yeah, that would be about a 20% drop. And remember, if 160.19 goes in this trend line, it has longer term implications. If let's see, because we're right above that weekly trend line, and that would be close. We'll have to watch both. Let's just keep an eye on this. Let's focus on what happens with QQQ and the bigger stocks here, and I'll put up some additional analysis. Maybe look at the futures on the small caps for anybody interested. All right, we're going to wrap it up here. I told you this would be a quick video. It went a little longer than I wanted, but that's what to look for. And again, do what you want, but with Apple on deck tomorrow night, we'll probably have a good idea which direction this market wants to go after that. So look for trading to maybe somewhat normalize on Wednesday. And I also made mention earlier today in the other video, it's 100 and something, I don't know, about 135 or so stocks, I think it is, within the S&P report this week. So it's not just Apple. There's a lot of earnings coming out, and going to be a lot of conference calls, guidance, and let's see if the trend on rally up into earnings, sell the news kind of thing continues. And if it does, I've gave you some levels to watch here. And we'll just have to take it as it comes. All right, guys, this has been Randy Finney with the right side of the chart. Have a great day.